Gary, wrapping up this week's version of the five things, we're going to talk a little bit about bonds in our investor education portion of the five things. Gary, thing number five, breaking down bonds, the yield price relationship explained. Gary, tell us more about bonds and yield price.
So, Rob, the issue here isn't that there's anything wrong. It's that the terminology that people use to talk about bonds is often inaccurate or misleading. We just sort of talk about things in a way that makes sense to us. And, people don't say exactly what they mean, but we know what they mean. So let me explain. The price of a bond and the yield of a bond are inverse to each other. So let's imagine that the you have a bond it's $1,000 bond, and let's say you have a $50 coupon on that, and so what you have is a 5% yield, right? 50 divided by 1,000 is 5%. Now, if the price of that bond falls, say it falls to, $500, and this is back of the envelope math, the bond math people, I know it's more complicated than this. We're just using a simple example for people.
Keep going, Gary.
Yeah, you can put it in the comments that this isn't exactly right. I know, just we're trying to simplify things. But let's say the price of that bond gets cut in half. It goes from $1,000 to $500. Well, your coupon is still $50, so your yield is 10%. Okay, so if the price of the bond falls, your yield goes up. If the price of the bond rises, the yield goes down. And the reason that matters is because we were talking about the Federal Reserve in September, in my opinion, unwisely cut the Fed funds rate. And ostensibly, the reason they said they were going to do it was to bring down borrowing costs for people. Well, the yield on the 10-year Treasury rose from 3.6% to 4.6%. It's the exact opposite of what the Fed wanted. Now, the reason that happened is because the bond market was saying, wait a minute, the Fed is lowering rates. We're going to have more inflation. They priced in higher future inflation and said, that's risky. We want a higher yield. And so the price of the 10-year bond came down, increasing the yield from 3.6% to 4.6%. Now, what we've heard people saying a lot is people are often saying right now, well, the 10-year is up. Now, is that correct? No, it's not. What they mean is that the yield on the 10-year is up. This is a situation where the language of finance is imprecise. So if I'm talking to, one of my friends, a fellow hedge fund manager who says, yeah, the 10 years up from 3.6 to 4.6, I know what he means. I know he means that the yield is up. But it can be confusing for people because the 10-year is not up. The price of that bond is down, the yield is up. And so what we want to do is explain to people that this is a situation where the vernacular, the common language of finance is just often inaccurate and imprecise. And if you talk to people all day, every day, you know what they mean. But when you hear people saying the 10-year is up, it is not. It's the yield that's up, the price is down.
Any additional questions for Gary? Leave those in the comments. Any clarification that you may need, or getting on him and letting know that your calculations aren't precise, Gary. So
Yeah.
I'll clean that up for future versions.
Yeah, we're not doing an hour-long bond math seminar here. Sometimes it's just good to give people the back of the envelope and help people understand in simple, clear terms what's happening. We're not trying to help an audience of non-professional investors price bonds. What we're trying to do is help you understand what people mean when they talk about it so that you can follow the conversation because these things are important. I do think we're going to see increasing bond yields over the next few years with higher inflation. The Fed does not have great control over this right now or any control at the moment. So these are issues that you're going to hear people talking about over the next few years. And it's just good to understand the language surrounding it. And that's where we're trying to help.